Hey everyone! Welcome back to Research Investment. I'm Simo, your equity research analyst, and today we are executing a strategic, data-driven analysis to answer a critical investment question. What is the fastest, most efficient path to doubling a significant capital base using high-quality, low-cost index funds? We'll model this using a clear objective, a hypothetical investor named U who has $1 million in capital and wants to purchase a $1 million home. The strategy is to invest the principal and use only the growth to fund the purchase, leaving the original $1 million untouched and compounding. We are going to count down the top 5 Fidelity Index funds, selected based on a rigorous framework of growth potential, dividend yield, and sector exposure to determine the most efficient route to achieving this objective. We will start with the most conservative and accelerate to the fastest. For this model, all dividends are reinvested, and we assume the capital is held within a tax-advantaged account like a Roth IRA to isolate the raw performance of each fund. At number 5 on our list, representing the most conservative glide path approach, is the Fidelity Freedom Index 2060 fund, ticker symbol FDKLX. This is a target date fund designed for retirement around the year 2060. Its structure is inherently diversified, starting with a heavy allocation to stocks and automatically shifting toward safer bonds over time. While this auto-rebalancing feature offers simplicity, the inclusion of bonds acts as a structural drag on both growth and income. The current dividend yield is a negligible 0.09%, and while the dividend growth rate is strong, the fund's total share price appreciation has averaged a steady but uninspiring 8.3% per year. Based on these metrics, our model projects it would take John 9 years to double his capital, reaching a balance of over $2.06 million. This path is reliable but fundamentally inefficient for an investor seeking accelerated capital appreciation. 9 years is a substantial waiting period. Moving to number 4, we significantly increase our exposure to pure equity with the Fidelity Zero Large Cap Index Fund, ticker symbol FNILX. This fund's primary structural advantage is its 0% expense ratio, meaning every single basis point of return is retained by the investor. It tracks the largest US companies, names like Apple, Microsoft, and Amazon, providing direct exposure to the core drivers of the American economy. The numerical profile is far more compelling. The dividend yield sits near 0.95%. Dividend growth has been running at a strong 11.72%, and the average share price appreciation comes in at a robust 11.17% annually. This combination of fee elimination and direct market exposure materially shortens the timeline. Our model projects John would reach the $2 million threshold in 7 years, a full 2 years faster than the target date fund. At number 3, we refine our focus to the institutional benchmark for American equity, the Fidelity 500 Index Fund, ticker symbol FXAIX. This is the classic S&P 500 tracker owning the 500 largest US companies and rebalancing based on market capitalization. This is the heartbeat of the American economy. The performance metrics are a step up in terms of pure growth, with an average share price appreciation of 12.65% per year. While the dividend yield of 1.13% is solid, dividend growth is more modest, which is typical for the mature blue-chip companies that dominate this index. The power here is in the consistent broad market compounding. Based on this higher growth rate, our model projects that John would achieve his $2 million goal in 6 years, shaving another full year off the timeline while maintaining a highly diversified core portfolio. Accelerating further to number 2, we introduce a thematic tilt with the Fidelity US Sustainability Index Fund, ticker symbol FITLX. This fund applies a sustainability screen to the US market, which in practice results in a portfolio heavily weighted toward modern growth leaders in sectors like software, cloud infrastructure, and clean technology. The numbers here are where the analysis gets very interesting. The average share price appreciation is an impressive 13.91% per year, but the standout metric is the dividend growth, which has averaged a massive 13.74% over the last decade. This combination of strong capital gains and rapidly growing income creates a powerful compounding effect. Our model shows that this fund would allow John to reach his $2 million target in just 5 years, a testament to the outperformance of high-quality, growth-oriented companies. Finally, at the number 1 spot, representing the highest velocity path to capital appreciation, is the Fidelity NASDAQ Composite Index Fund, ticker symbol FNCMX. This fund is not built for diversification in the traditional sense. It is a pure play momentum engine tracking an index dominated by the innovation economy, technology, communication services, and high growth consumer companies. The portfolio is heavily concentrated in the world's most dominant tech platforms, including Apple, Microsoft, Nvidia, and Amazon. The dividend metrics are secondary here. The entire thesis is built on raw price appreciation, and the historical data is undeniable. The fund has averaged an 18.67% growth rate per year, a pace that is simply unmatched by broader market indices. This level of acceleration dramatically alters the timeline. Our model projects that John would cross the $2 million threshold in a remarkable 4 years. This path will inherently come with higher volatility, but for an investor with a clear objective and the discipline to withstand short-term fluctuations, the NASDAQ Composite represents the most powerful and efficient engine for wealth creation available in the public index fund market. So, to summarize the countdown, we've analyzed 5 distinct pathways, each accelerating the timeline. The Fidelity Freedom 2060 Fund set our baseline at a lengthy 9 years. The Zero Large Cap Fund, by eliminating fees and concentrating on blue chips, shortened that to 7 years. The classic Fidelity 500 S&P 500 tracker brought the goal into view at 6 years. The Sustainability Index, with its tilt toward modern growth and high dividend growth, accelerated the timeline further to just 5 years. And finally, the NASDAQ Composite Fund, with its unparalleled exposure to the innovation economy, presented the most efficient path at a remarkable 4 years. Now we must conduct the final stage of our analysis, determining optimal selection. While the 4-year timeline of the NASDAQ Composite is mathematically superior, a sophisticated investor must weigh velocity against volatility and concentration risk. The NASDAQ's heavy weighting in the technology sector, while powerful in a growth cycle, also exposes the portfolio to significant drawdowns during sector-specific corrections. An investor's ability to stay the course through that volatility is a critical, non-negotiable variable. Therefore, for an investor like you who has a specific non-negotiable financial goal and is not simply chasing the highest possible return in the abstract, the optimal strategy often lies in a blend of efficiency and stability. The Fidelity 500 Index Fund FXAIX and the Fidelity US Sustainability Index Fund FITLX represent the strategic sweet spot in this analysis. Both offer substantial acceleration over a simple target date fund while maintaining broad diversification across multiple sectors of the economy, insulating the portfolio from the idiosyncratic risk of a single industry downturn. The 6-year timeline of the S&P 500 tracker FXAIX provides a highly reliable institutional-grade pathway to the goal. It is the benchmark standard for a reason. It captures the core earnings power of the American economy with minimal tracking error and razor-thin costs. For many, this represents the ideal balance of speed and sanity. However, for John, whose objective is clearly defined by speed, the Fidelity US Sustainability Index Fund, FITLX, emerges as the top pick from this analysis. Its 5-year projected timeline represents a material acceleration over the S&P 500. Yet it achieves this without taking on the extreme sector concentration risk of the pure play NASDAQ fund. Its portfolio of modern growth leaders, combined with a superior dividend growth profile, offers a powerful dual-engine approach to compounding. It is faster than the broad market, yet more diversified and fundamentally sound than a pure technology bet. This fund allows John to achieve his goal in a highly efficient 5-year time frame, transforming his dream home from a distant concept into a concrete, medium-term financial plan, all while keeping his original $1 million principal intact and compounding for the future. This analysis demonstrates a critical principle. Index funds are not monolithic. They operate at vastly different speeds, and selecting the right one requires a clear understanding of your timeline, your risk tolerance, and the underlying economic drivers of each index. Thank you for tuning into this strategic deep dive. If this data-driven analysis provided a clear framework for selecting the right investment vehicle for your own goals, please hit like, subscribe, and share your thoughts on these funds in the comments below. We will catch you on the next video. Good luck on your investments.